what we've seen with the past stimulus checks, the previous round in the spring, is that a lot of that went into savings and paid down debt. So, this idea that it's going to go straight into a new iPhone or into something else tech related, I'm not sure exactly excites investors as far as like a direct link between stimulus and those businesses doing well. I don't think you need stimulus checks for Apple's business to continue to do well. There's a number of drivers there. The iPhone 12 cycle looks like it's pretty spring loaded for 2021. We're pretty optimistic on that 5G upgrade. Meanwhile, their services category with higher margins continues to take up more of their business. So we think that's a good long-term story. And then if you look at some of the other technology companies, Amazon has done very well with or without stimulus. I mean, that's become a tech utility both in the cloud and e-commerce. So, these technology companies have, really great business models. They're the leaders in their categories. And, we think they're probably good earnings growth stories going forward. I'm not sure you're going to get a lot of multiple expansion. That's been the story of the last 3 to 5 years. But earnings growth for these companies look, anywhere between 15 and 30% going into 2021. And I think even if valuations are stable, and we've seen a fairly good consolidation in these stocks, a healthy consolidation over the last 4 to 6 months, then I think they can still be good investments for investors.
Well, Jason, I think you hit a hot button issue right there. Valuations. Are these stocks overvalued, or have they become basically, like you said, tech utilities that there is no real ceiling for them?
Yeah, it's a great question. And, we don't think the valuations on the large technology stocks that we own look unrealistic. Whether you're looking at Apple at 30 times next year's earnings or Microsoft at 30 times next year's earnings, we like Visa. It's also a technology stock in our view that doesn't get a lot of discussion or focus among those FANG names, and it's trading around 30 times forward earnings. Google's at 27, 28 times. So I think if you look at it from a PE perspective, they're not terribly expensive, especially with low interest rates. If rates remain low, I think there's a case to be made that, stocks trading between 25 and 35 times earnings with these kind of economic moats and these types of returns on invested capital. And, just look at the reinvestment in the businesses that say Amazon is doing. I mean, it's hard to compete against these large tech companies, and they're only getting stronger and larger as the pandemic went on, as you mentioned, that tech utility profile. So I don't think they're terribly overvalued. If they were at 50 to 70 times, maybe we'd have that conversation. There are parts of tech that seem frothy, but large cap tech to us seems realistic. Real revenues, real profits, real free cash flow. These are good businesses.
All right, so speaking of growing stronger throughout the year, we got to talk about Tesla. So you mentioned the valuations of some of those other tech companies like Amazon. Looking at Tesla, trading at 180 times forward earnings. Are all the Tesla, you just had to say, yeah, no, you had to jump in.
Yeah.
Are all the Tesla believers right? Are we all missing something, or is this stock overvalued?
Yeah, Tesla's not a stock that we own in the portfolio, and part of that's because it's always been expensive. And good growth companies oftentimes will carry that profile. Amazon, for example, has always been expensive on a PE basis, and we own Amazon, and we prefer to look at Amazon on a free cash flow basis and on a sales basis. So maybe some investors are looking at Tesla's potential through that lens. Again, we don't own it, so I don't have a real strong opinion on where Tesla stock goes. Obviously, if we were bullish on it, we'd have it in the portfolio. I think what they're doing is really exciting. Their total addressable market in EVs, and they are, without question, the dominant player in electric vehicles. I mean, this is a $300 to $400 billion total addressable market by 2023. That's exciting. I understand why investors are putting that valuation on the stock, given that they're obviously a big player in the solar industry with their purchase of Solar City. Battery technology is going to be a huge business over the next decade. So investors are pricing in a lot of future growth for Tesla. And the question of whether or not that's too overvalued right now is not something that's probably going to trip up the stock, but ultimately it's going to have to grow into that valuation, and it might be a bit tricky. So for now, we are not owners of the stock.
Can we touch on one other part of the tech world, Fintech? You see Square and PayPal having very interesting years, and again, they're have very high forward PE. What's your take on them, especially with the weak dollar? Do you see them strengthening, at least in the Q1 of 2021, as all of us, until the vaccines kind of proliferate, are still going to be kind of stuck at home?
Yeah, I don't think the weak dollar is going to have a whole lot of effect on the PayPal, Squares of the world. I think really it just comes down to the secular growth and the dominance that they have in those industries. We own PayPal in one of our a little more aggressive growth strategies. It's been a great stock for us. Square we don't own, so I don't have a strong opinion on that. I think Jack Dorsey's done a great job with that company, and it's had a heck of a run. Our preferred tilt in fintech is through Visa and a company called Fiserv. Both of these are strong growth companies, durable growth companies that have had, double-digit earnings growth for as long as, you go back and look. These dominate those particular niches within fintech. So I think it's a space that you still want to continue to have exposure to if you're an investor. There's a lot of reasons to think that the digitization of payments is going to continue to be a dominant story over the next 10 years. Visa, for example, not only has a secular growth story as a duopoly in credit cards and debit cards with MasterCard, but they also have a bit of a cyclical story as well as the economy reopens up, not only buying online, but as we get back to normal activities. Visa is a toll collector in that industry. So I think you can own fintech. You should own fintech, but do it through companies that have a little bit better valuation. I think PayPal's a good stock. We like Visa. We also like Fiserv.
Shepard Smith here. Thanks for watching CNBC on YouTube.